Good afternoon, folks. I think we've got a few participants still rolling in. We'll get started in just a minute. All right, we are here at the top of the hour. Good afternoon, Liberty Wealth clients and friends. It's good that you're all able to join us this Friday afternoon before taxes. So I hope many of you have put that way in the rear view. And for those who are still adrenaline seekers and looking to conclude this weekend, perhaps we're providing you a good reprieve in the midst of doing some number crunching for your final return for 23. So thank you for joining us. You know, we're excited to bring quarterly content like this to you every handful of months. And this afternoon, we're joined by a couple of great colleagues that I think you've met beforehand a few times. Before we get started, though, by way of just some quick housekeeping here, and then all the fun disclosures you can read through. But at the bottom of your screen, we have a question and answer section. So if you're inclined to kick over a question to me and time allows, we'll get to that at the end of the presentation. Many of you have met two colleagues from Prime Capital, wonderful friends and partners. We have Will McGuff presenting today, our portfolio manager, along with our Chief Investment Officer, Scott Duba from Prime Capital. Working alongside them the last 16 months, and they're here to present today some interesting findings this past quarter. Hopefully we'll have a little fun as well in the mix of all this stuff. So without any additional delay, Scott, I'll kick it over to you and we'll get started. Ooh, Scott, I don't think we can hear you. I'm going to interject there.
Was that better?
Much better. Thank you, sir.
Thank you for the reminder. Well, good afternoon, everyone. Thanks for joining. For those of you that don't know us, Liberty is a partner firm of Prime Capital. We're a national firm that does wealth, retirement, and institutional investing. I think it often goes unnoticed how large and how capable our firm is. So just remember to reach out to your Liberty Wealth advisors because they're tied into an organization that can do just about anything you need. So with that, let me talk about where we're at. Those of you who are fans of solar eclipses can probably recognize what we're looking at here. Many of you viewed the totality a few days ago. And much like viewing an eclipse, we're here to give you the eye protection to view the markets. So, you know, you don't want to stare directly at the sun, nor can you get all the information you need by staring directly at the numbers. So our task today is to give you a little bit of perspective and protect you on the way forward. So to open up, let's look at some headlines. Q1 was great. The S&P rose to a record after a monster first quarter. That was the 22nd all-time high of this year in Q1. You have very speculative assets like crypto, Bitcoin surging, which we view as somewhat of an indicator of animal spirits in the market. You have inflation still a bit troublesome in the mid-threes, coming in higher than expected in March. On the international front, China remains a bit of a concern, uncertain economic prospects to say the least. We've obviously got an election coming up in the fall, which will be tons of fun and potentially volatile for the markets. And you've got simmering geopolitical, well, not even simmering, hot wars in both the Ukraine and the Middle East, which has obviously had impacts on commodity prices, namely oil. So, per usual, there's many things to think about and a lot of moving parts of the markets. The last and not least of which is AI, which has been a huge headline. Just about every sector of the economy has driven a lot of the market performance year to date. So our task today with the Q&A will be to provide a little bit of perspective about where we're at and kind of where we think we're going.
Great. Well, thanks, Scott. Starting things off, I think it's a natural launch pad, if you will, talking about 2024 market performance. how we're doing so far, and how that compares to prior years. Will, if you want to get started there.
Absolutely. And I just want to thank everybody again for taking the time. Annette mentioned you're probably working on taxes. I was going to say probably taking time away from watching the Masters if you're a golfer. So certainly appreciate your attention for the next 30 minutes or so. What we're showing you here is the annual return of the S&P 500, along with how much the S&P 500 was down each calendar year. So the red dot is essentially the drawdown for the S&P. Now we're looking at full years for every year except for this year, which we only have a 1 quarter, and the S&P was up over 10%. The S&P was also up in January, February, and March. That's happened 20 times throughout the S&P's history. 19 of those 20 times, the market ended up higher on the year. With the 10% return in a quarter, that's actually happened 11 times in history, and we've seen 10 of those 11 end up higher on the year. So just basing off some simple numbers for Q1, it's looking like, we may end up a little bit higher from there. But there's a lot of push-pull going on with what fixed income is doing, and we're going to show you that on the next slide. And this is the Barclays Bloomberg Bond Aggregate, which is a large barometer of the total bond market in the US. The obvious sticking point here is 2022, down 13%, which hasn't happened in history. Kind of a perfect storm combination of interest rate moves coming off a very ultra low interest rate policy for many, many years. We had a rebound last year, and this year bonds really aren't doing much. So we're seeing kind of a push-pull again between what the Fed's going to do, what the market thinks the Fed's going to do. Bonds have been down about 3% throughout the first quarter, landing about down 1% for the quarter. As we zoom out on the next slide, we'll show you how these asset classes have performed year to date in very general buckets. So large cap growth or large cap stocks, the S&P 500 that we just showed you, up 10%. It's the best for these asset classes that we're showing you right now. We have international stocks up about half of that, so call it 5.8%, right there with small caps. So you can see US stocks are really doubling up the other major asset classes. The one I always like to point out is real estate. It's actually been a very solid investment over the long term and has a place in many of the Liberty portfolios. You'll see in 2010, 11, 12, 14, 15, 21, it was the best performing asset class. But 3 of the last 5 years, it's been the worst. So that'll be an interesting one to watch to see if it regains its place among the top or if it's going to continue to kind of languish there at the bottom. As we jump forward, we're going to zoom in a little bit underneath the hood of the equity markets. So first, we want to show you some major inflection points. What we're trying to do here is simply highlight highs and lows, peaks and troughs. If you really think about the last 5 years, we've had 3 bear markets. In 2018, we were down 19.5. I think we'd all agree that could round up to the traditional 20% drawdown definition of a bear market. We had the COVID crash and we had 2022. And so all 3 of those markets have happened over the last 5 years, but we're an all-time high. So it just goes to show you the value of sticking with a long-term investment plan throughout the bad times, because you need the good times to ultimately compound the value of your assets over time. When we jump forward one more, we'll look at how this has affected consumer sentiment. As you can think about markets being at an all-time high, you would be a pretty good assumption to say that sentiment is bullish. And when sentiment is bullish, we see that classified as greed. When folks are bearish, that's fear. And so there's a mean reversion cycle that goes on. When the markets get too frothy, there's a lot of greed taking place. We tend to see things pull back a little bit. So we're going to have to counterbalance the enthusiasm with extreme greed readings with how the markets may play forward the rest of this year. On the next slide, we're going to get into exactly how investors think about value in the S&P 500. So there's 500 stocks. Each of those stocks should hopefully have some earnings, some don't. And then as investors, we have to figure out how much do we want to pay for those earnings. And so there's a multiple involved. So the S&P in aggregate earns about $225 a share. It's about $5,100 right now on price. So that's about a 20 to 21 times multiple. And what you'll see on the far right is we're nearing the peak multiple of 2021 and 2022. And last year, which was 2023, there was no growth in earnings for the S&P, but the S&P went up, and it went up from exactly what you're seeing right here. It went up because of earnings multiple expansion. And so we're really at a point right now where we need to see the S&P earnings grow because there's a little bit of a lid on the multiple growth here. So earnings season's kicking off. It kicked off yesterday. We're going to be watching to see how that plays out. And ultimately, if the market can see some growth, and they've got some frothy growth expectations of about 9 to 14% earnings growth, which will be pretty important to see if companies can hit those pretty high numbers relative to prior estimates of growth. Let alone with growth, on the next slide, we're going to jump into showing you a huge theme that's been playing out of late. And you've most probably all heard that the market is being really driven by a core group of stocks called the Mag 7. But before we get to the Mag 7, we just want to show you here over time on the left how the top 10 stocks compare to the remaining. It should be 490. There's always plus or minus a few from the 500 stocks in the S&P to the remaining stocks of the S&P 500. And that same earnings multiple I just talked about is higher for those top 10. It's Amazon, Facebook, Google's of the world. They're commanding more of a premium on their earnings, hence a higher multiple. And you'll see that their weight in the S&P 500 on the top right has grown to the largest value that we've seen since the mid-90s. The top 10 stocks comprise about a third of the S&P 500, when at the dot-com bubble of 99 to 2000, we were just under 30%. So it's something to watch. These stocks have an outsized effect on how the index is going to play out. And obviously, having just talked about earnings and multiples, those two pieces of important information are really going to play into how the S&P is going to behave the rest of the year. And with that, let's actually look at the Magnificent Seven to see how they have performed. And by no surprise, it's kind of old news here, the Magnificent Seven are the drivers of the market. So in 2024, they're up about 13%. We've talked about the S&P being up 10%. So the rest of the S&P 500 is up about 6%, which is similar-ish to the number of small cap stocks and international stocks. So you can really see the premium that the Magnificent Seven is driving in the market today. We've seen it before. These are long-term trends. They can last forever. We don't have the crystal ball of when that will change, but these Magnificent Seven are really with the tailwind of AI. And for that, I'll turn it back over to you, Annette, to lead us up for our next section.
Sure, that's a good segue then, speaking of Magnificent Seven. So then we love talking about AI. It's in the news a lot. Are we in a bubble? Scott.
Sure. Thanks, Annette. Thanks, Will. Yeah, I would say to start with, let's just kind of level set. The interest in artificial intelligence, the public mind has just exploded over the past couple of years. On the left-hand panel here, you can see Google Trend Search volume for AI. It's about 10x since late 21. But on the right, you can see corporate America taking notice of this. The percent of S&P 500 companies that are mentioning artificial intelligence has gone from effectively none in 2015 to about 40% in Q4 of 23. And I'd frankly be surprised if it's well over half after we get through Q1 earnings. So if you go to the next slide, there's interest in this. Everyone's curious. The public, corporations, what's AI? What's it going to do? What sectors is it going to impact? This analysis here from our friends at Goldman Sachs does a good job of laying out the relative exposure of different industries to AI potentially impacting employment or how jobs are done. The dark blue sections of these bars is really low exposure automation. This is construction, manufacturing, cleaning, janitorial, building, grounds crew maintenance, just things that robots, AI can't do. The gray is areas that have a lot of potential replacement. Legal work, office and administrative support, things that are, very computational. The light blue panel in the middle, or sorry, the light blue portion of the bar chart are kind of the things that have AI as potentially a complement. So if dark blue is no automation, gray is likely replacement, light blue is AI can probably help someone do this job better. And if you look at the red box bar in the middle, this is the proportion of all industries that fall into these categories. Of all sectors, of all employment in the US, there's about 25 or 30% that'll see no automation. There's about 90% or 80 or 90% that'll have AI as a complement, and the balance is areas in which AI will replace work. Now, important for us, Will and I and Annette, we pay attention to the red box all the way to the right, which is business and financial operations. According to this survey, there's probably about 5 or 10% of the job that'll likely get replaced. Hopefully not me, and about 95% of it in which AI will be a complement. And so what we're doing already is using AI as a complement. And then if you go to the next slide, there's a couple different ways that we in our business are already seeing the impacts of AI on our productivity. First example would be as a research co-pilot. Just in preparation for this webinar, I had to look up a statistic about 10-year annual productivity in the US economy. To do that, I could have gone to Google, or I could have gone to the Bureau of Labor Statistics myself. I could have built a spreadsheet. I could have spent a half hour, an hour, 2 hours trying to get the data. Instead, I just pulled up my ChatGPT subscription and asked ChatGPT this exact question. And within 10 seconds, I had a response that told me, as of January 2022, according to the US, this 10-year rate was between 1% and 2%. Now, obviously, we had to go vet and confirm this information, but this just goes to show you I basically took a job that would have taken an hour and did it in 1/100th time. You go to the next slide, Annette. Another way we're using AI in our business, and others using it in other businesses, is to generate computer code, programming code. So we use a fair amount of statistical analysis tools to manage portfolios, to get portfolio statistics, to monitor different relationships and variables. When we're building these programs in various applications like Python, instead of starting from scratch to write a code base, we can now just ask ChatGPT to generate computer code to start us on building different models. So this is an example of just that. Instead of taking a half hour or an hour to type a bunch of code, we can just ask AI to start us out with a baseline level of code to run a certain program. And then the third example, go to the next slide, Matt, would be an image creation. I'm sure you all have seen some examples of videos or pictures being created by AI. This is an example of what you get back if you ask for an image of a Midwestern investment portfolio manager. You get a pretty plausible picture, maybe a little bit stylized, but someone that looks like either an old version of Will or a young Warren Buffett, somewhere in between there. But a guy where you're like, yeah, he looks like a portfolio manager. But importantly, if you just adjust your request to the model a little bit and ask instead for the image of a Midwestern portfolio manager with a lot of kids, you get some more troubling results. What you get is something called a hallucination in the artificial intelligence world. When you put a question into a large language model, you're not actually interacting with a human, you're interacting with a database that's trying to take the characters that you punched into a prompt, translate that into a question, and then generate a thing to answer your question. And this just goes to show that this is not quite ready for prime time. This is a 5-year-old portfolio manager instead of a portfolio manager with kids. And so you can see that even though these tools are powerful and they can add a lot of productivity, we're still in the early stages of deploying this technology in the US workforce and using it at scale. That leads us to our next slide, which is how we think about AI and its potential adoption path. What this chart lays out is 2 examples of prior transformational technologies and how those actually both got adopted as well as impacted productivity in a given sector. The dark blue font in diamonds is electrical manufacturing. And what you see is that on the bottom time scale, the electric motor was developed around 1900. And as those blue diamonds moved up and to the left, adoption went from basically nothing in 1900 to about 50% of use cases in electrical manufacturing by about 1920. So it took 20 years for this technology to get to about half of applications, half of use in manufacturing. The other example on the top axis is the red dots in the red font. This is personal computing, the personal computer. The personal computer was adopted or invented rather in about 1980. It wasn't until about the mid 1990s, around 2000, when it was common to have a personal computer in the workplace. So again, it takes 20 years to reach the 50% adoption threshold. And what you see if you kind of follow these lines is that gray section in the middle. This is when the productivity boom typically starts. It's not 1 year after something's adopted. It's not 5 years after something's adopted. It's usually about 15 to 25 years when you actually see the impact of a technology on real productivity in a given workforce. Mm-hmm. And so when we think about AI, we think it'll be probably 5 to 10 to 15 years before we really see the impact on U.S. labor productivity growth. Again, going back to that Chat GPT question, the baseline is about 1 to 2% historically of U.S. annual percent change in labor productivity. That's shown in this left panel, where if you just drew a line through the middle, it's about 1.5%. The gray bars on here, or the gray sections, show first the electrical motor impact on productivity in the late teens, early 20s, into the 30s. And then again, for the impact of the personal computer around 2000. So when we think about AI, we think in probably 5 to 15 years, maybe sooner than these old technologies, we'll see about a 1.5 to 3% impact on productivity. And you see this on the right. Again, these are Goldman Sachs estimates. Their baseline assumption is that the effect of AI adoption will be a 1.5% benefit to annual productivity growth, which is quite material on a base of 1 to 2%. So almost a doubling of productivity. On the low end, they think it could be as little as 1/3%, and on the high end, it could add as much as 2.9% to annual productivity. So this is important because if the question is, are we in an AI bubble? This tells you that this is a real thing, it's a powerful thing, it will have implications. The question is, when will it? And is the market ahead of itself? We go to the next slide. An important comparison is the dot-com bubble from the late 1990s, early 2000s. In that case, when the internet was first being commercialized and monetized and brought to a lot of different business models, there was obviously a ton of excitement in the markets, and several of these very large technology, media, telecom stocks ran up significantly. 3 examples would be Cisco, Microsoft, and Intel Corp. In 1999, the return of those 3 was between 40 and 130% each. And in 2000, they were all down between 1/3 and 60%. Now, why did that happen? What happened was these companies were growing very rapidly in 1999. Cisco was growing about 40%. Microsoft was growing about 16%, Intel about 16%. But the market started to assume those growth rates would continue. And what happened was, even though these companies mostly kept growing, they didn't grow quite fast enough to keep pace with the growth expectations in the market. And what happened was the multiples at which these companies were trading collapsed. If you look at the bottom right-hand corner of this chart, Cisco is trading at 20 times forward sales in March of 2020, and it fell to 4 times forward sales in March of 21. Microsoft was trading at 20 times in March of 2000. It fell to 10 times sales in March of 2001. Same effective move in Intel from 13 times sales to 6. So while this internet technology obviously ended up being transformative, we got to be aware of the market potentially getting a little bit of ahead of itself in terms of the when. Go to the next page. When we look at where the large TMT stocks are trading today, those being up, somewhat inflated on this hype around AI, it's not quite as bad or as frothy as it was for the TMT stocks in the late 90s. If you look at this chart, the dark blue is the median forward PE ratio. The light blue is the rest of the market. The dark blue being just the top 10 TMT stocks. Around 2000, this ratio got to about 40 times, 52 times forward earnings. As of right now, for the top 10 TMT stocks, it's in the high 20s. So certainly elevated versus the rest of the market, but not as bad as it was in the dot-com bubble, nor even as frothy as it got in late 2021 post-COVID. So you're certainly not buying the market cheap on these TMT stocks. As you can see, relative to 2010s and the pre-dot-com era, the TMT sector is certainly trading at a high multiple relative to the market, but it's not yet quite as bad or frothy or as elevated as it was during the dot-com era. Go to the next page. The other thing to put in perspective is how hard it is to grow fast and maintain profitability for a long time. The panel on the left shows that there's only about 10% of companies that can grow their revenue consistently above 10% for 10 years. So if we're looking at these TMT names, these technology names, if they're all assuming 50% growth, we've got to be skeptical of that. And we've got to find the ones that we really think can pull it off. And on the right-hand side, this is the share of unique S&P companies that have greater than 50% operating margins for consecutive years. This is an even more elite category. There's about 2% of companies that can do it for 1 year, but there's a fraction of a percent that can do it for more than 7 years. So this is just making the case that when we're looking at companies to invest in our portfolios, we want to have a very, very high bar for really underwriting above market earnings and profit growth for many years at a time. And I think this is our last slide on this section. This is just looking at kind of what the embedded growth rate is for these TMT stocks today. And again, it's not as frothy, not as elevated as it's been in the past. During the dot-com boom, the median growth rate was assumed to be in the mid-20s. Post-COVID, in October of 21, it was assumed to be 18%. As of today, it's about 15%. And again, that's elevated versus the S&P median of 11%, but it's not quite as frothy as it has been in the past. So,
we got one more.
Yeah, so the question of whether or not we're in a bubble, we don't think we call it a bubble. Is it elevated? Is there some of the AI growth that's being pulled forward into the market? Absolutely. But bubbles typically are way more inflated with much less fundamental impact to it. We would characterize this as a little bit of over exuberance that deserves more scrutiny on what you own and how much you own it to make sure that you're diversified across multiple names. What this last slide shows is the market implied growth rate. And right now, the market's implying about 11% EPS growth. That's a little bit above the long-term average. But again, it's not the 16% we saw during the tech bubble. So Annette, hopefully that answers your question. And I'll turn it back to you for our next section.
And then some. No, that was really great content. Thanks, Scott. Switching gears, I guess, a bit. Will, what are your thoughts on inflation, what we're going to continue to expect to hear from the Fed?
Yeah, thanks, Annette. And it's
Sure.
Good deep dive there on AI, Scott. Enjoyed listening to that. So if we think about what's going on in the market, inflation's a huge driver to the news. Everybody's well aware of the effects of the post-COVID stimulus and prices going higher. And it's really, the Federal Reserve has two basic things they try to do: maximum employment and price stability. And so here we're going to talk about price stability, which is through inflation. And this chart we're showing you here is how inflation has ebbed and flowed over time. And unfortunately, it's through the end of the quarter. There was an inflation number that came out yesterday, and it was a little hotter than expected, and it's been that way for a couple of months. So we're just like 1 or 2 basis points over what the consensus is. And so this is an annualized number. So the monthly number that came out was a 0.4 inflation reading. Market was expecting a 0.3, and it's really because of rounding. The numbers came in at 0.355 versus 0.354. It would have rounded down. So a little bit of market nuance there for you. Nonetheless, inflation is coming down because the Fed has raised rates, and ultimately that's what caused all the disconnect in the markets in 2022 with equities and bonds being down. So if we jump to the next slide, we'll see how inflation is attributed. And what you're seeing here is the actual annual CPI inflation rate. And then now each bar, each report is colored by its contribution of its subcategory. And so if we look at the chart on the left, the main driver of inflation is shelter. You can see it goes from like 1.5 up to 2.5, back to 1.5, and energy. So those are the two main drivers of inflation. But the one that's kind of interestingly rearing its head, and Larry Fink, the CEO from BlackRock, was talking about it this morning on CNBC, is insurance. It's that red bar that kind of starts at nothing on the left and ends up, kind of being about 0.5% on the right. And that's an interesting one because, everything that's going on in the world with, having to insure higher home prices, cars cost more. So insurers were a little late to adjust. And it's one of the evil necessaries of the world is that you have to insure things like home and cars. But nonetheless, insurance is kind of the most interesting one to me here. And on the right, if we look at CPI X core services, which is taking out shelter and energy, you can really see the effect of auto insurance. It's a predominant driver on the far right. And so it'll be interesting to see if the insurers get to a point to where they're fully back to be able to insure their books of businesses. But the story here is inflation has come down a little bit above the Fed's goal of 2%. We're just north of 3%. Talking heads are saying if they can just get it under 3, like get a 2 handle on there, so 2 point something, the Fed will declare victory. And with that, on the next slide, we'll look at how the Fed is thinking about managing their short-term rate, which is what they use to combat inflation. So as we all know, post-COVID, inflation took off. Fed had to take off in response, which was from 21 through 23, the move from basically 0% interest rates to 5.38% interest rates on the short term. And this time 3 months ago, when we were talking with you guys, it was all about how many cuts the Fed thinks they're going to do in the year versus how many the market thought. And so we started with the Fed potentially cutting 6 times. The Fed governors put a projection out that shows where they think rates will be in the future. And the average of those projections was about 6 cuts. This time 3 months ago, the market was thinking 3. So that's actually converged. So when we talk about bonds being down, it's because rates are going up. It's that convergence that's taking place right now, the push and pull between bonds and stocks. We've seen some headlines where there's some Fed governors saying there may not be any rate cuts this year. So that's kind of extreme, as Fed people love to control psychology through the way they communicate. And so they're putting feelers out right now to see how the market is going to react to some of the headlines there. So with inflation being sticky, the Fed has to rethink their projections from earlier this year. The market was right, as the market usually is. And we're in this period where there may not be any rate cuts, which means higher yields. But fortunately, higher yields are good because they help buffer any higher rates with the move there. So you kind of have a chance to get income plus total return if rates do start to go down in the future, which is why we like bonds in this position. On the next slide, we're going to jump forward to the other key tenet of the Fed, which is maximum employment. And so here we're looking at unemployment rate and wage growth. And inflation was actually a good thing because it caused companies to pay their people more so they could buy more stuff, goods and services. So this time 3 months ago, wages were growing over 5%, which is above long-term average. And so now we're coming back down. It's about 4.5% right now. Long-term average is 3.9. So It's a little concerning to see this come down, but we do have to know it has spiked and still above trend. So I'll say let's check in on this chart 3 months from now and see if we're back at average, or if this thing's going to level out a little bit above average. So if we think about unemployment, there's two things with labor. The first one we're going to talk about on the next slide is demand. And so this is job openings. So companies need to hire workforce, and to do so, there is job openings. You can look in all the like LinkedIn boards, hiring boards. And what we're seeing here is that demand for employment from the corporate side has waned a little bit. And so we're still above the peaks of 2000 global financial crisis, but not where we were in the post-COVID flush. So something to watch here is that we're seeing less demand, but we're also seeing less layoffs on the bottom left. So kind of a good and a bad here. The most interesting one to me is the labor supply, which is the next chart. And what you're seeing here is, we're actually seeing folks come to the workforce, and that's going to be shown on the top right chart. So this is the workforce growth year by year from 08 to 23. And we're actually seeing the immigration, the positive side of immigration. I know there's a negative side of immigration, which we won't touch on here, but America does like immigrants to come in the right way, and foreign-born workers are comprising a little over half of the labor force growth, which is a good thing. So there's been a lot of demand for work, and now we're seeing supply being backfilled by the legal immigrants. And you're also seeing people come back to the workforce, which is the bottom right. So we're above post-COVID, early retirement boom that we saw. About 77% of folks 18 to 64 are back looking for a job or in the workforce, which is a good thing. And finally, we're going to cover the consumer on the next two slides. And so if we think about the US economy, it's about 70% driven by the US consumer. And we need the consumer to go out and buy goods and services to keep the economy flowing. And there's kind of two factors that are at play here, both related to, again, the COVID era. So all the rescue packages that we saw from the Fed and DC on the fiscal and monetary side was massive, like trillions and trillions of dollars direct to consumer, direct to business, to ultimately get through the issues that surrounded shutting down the economy with regards to COVID. And so I'm going to actually start on the top right here. That savings glut, all that liquidity was not spent early on. So if we look at the blue area, that is the peak excess savings by the consumer was $2.3 trillion. A little bit of delayed effect post 2020. So maximum savings was at the end of 2022, which is right when inflation started kicking in. And you'll see that consumers have been using those savings to help buffer the higher prices of inflation, which has actually given the Fed a little bit of a runway to orchestrate their no landing scenario that we're projecting right now. A lot of folks thought there was going to be a recession, but right now we're kind of in this no landing, no recession viewpoint. And as you would guess, if we're drawing down our savings, that means that we're not saving as much, which is the personal savings rate on the left. So the average savings rate by the consumer over time is about 8.5% per year. Unfortunately, about half of that. So again, both of these slides kind of giving you a balance here of the good and the bad. And all that's going to lead to the consumer balance sheet on the next slide. And so if you think about a balance sheet, you have assets and you have liabilities. The great thing about the ultra low rate policy of the Fed over the last 10 years was most Americans were able to get into a very lucrative mortgage at very low interest rates. And so unless you're forced to move for a job or some other reason, most people are sitting pretty good in their house. Their house value's gone up, their mortgage rate's low, inflation's higher than mortgage rates. So you're actually making money on a real basis instead of a nominal basis. And so the liability side of the consumer finance sheet is actually pretty good. And as I mentioned, home prices going up. So the consumer's balance sheets are actually in a really good spot. Their consumer debt to service ratio is down, although it's rebounded off of the peak on the top right. But to balance this with the potential negatives, we're going to look at delinquencies. And you'll see here with the student loan, it's flatlined from some policies in DC, but with credit cards and auto, it's ticking up a little bit, but we're still below what I would say was the average since the global financial crisis. So we're right back to where things kind of have always been. And as long as we don't continue to go higher there, I think the consumer's in a good spot. And finally, all this is going to lead to like what the market thinks the recession probability is. Last quarter, this was at 50%. And we kind of gave you a little bit of evidence that we thought maybe that was too high. And so now we're at about 35%. So there's a 1 out of 3 chance of a recession upcoming with the US. My personal belief is it's still a little high here as the no recession scenario looks more and more likely. But as investors, we have to just balance all the risk with all the potential rewards and be cognizant of what's out there. And so there still are risks with regards to a portfolio, which is why we work with your financial advisor to help you build the right balanced allocation between equity and fixed income to meet your goals and objectives. So with that, I'll turn it back over to you, Annette, for our last section.
Sure. Thanks, Will. I guess concluding thoughts from either of you. Scott, let's start with you.
Yeah, thanks, Annette. Yeah, I think this slide is a good one to keep in mind. With Will having kind of gone through the market returns year to date being above average, valuations being a bit stretched, concentration in the top 10 being somewhat of concern, and our commentary on AI being not quite a bubble, but certainly a little bit of foam. I think this part is important. It's what does it look like if I am investing at an all-time high? In the chart or the table to the right, it's actually surprisingly reassuring in this regard. What it shows you is the average cumulative S&P 500 total returns if you had invested on any day over the past 35 years or during a day that was the new all-time high. And what you see between the gray and the green bars is they're pretty similar over the long term, and frankly, better further out you go. If you look at the 3-month returns, which frankly we don't care much about because we're long-term investors, yeah, you might marginally underperform on average if you're buying into the market at an all-time high. But if you look out over 3 years, it's surprisingly a better cumulative return if you bought in at a high day versus any other day. Now, one thing I would note here is this is from 1998 or 1988 to 2023. It's not a total all market timeline analysis, but still, it makes us feel better advising clients to keep investing, stay committed to a strategy. If you're sitting on cash, maybe don't deploy it all at once, maybe dollar cost average over the next year, a few quarters, but rest assured that over the long term, it will compound as it always had. And if we go to the next slide, I think one other element to be cognizant of is the difference between a market cap weighted return and an equal weight performance. The S&P 500 is a market cap weighted index. That should be obvious, but it's worth repeating. When Will was describing those magnificent 7 stocks, if a stock outperforms over a long period, it becomes a bigger part of the portfolio. And right now, those top 10 stocks, they represent about 1/3 of every dollar you have in the market. And what this table shows is the green lines are areas in which the market cap weighted index outperforms an equal weighted index. Equal weighted index would be, instead of owning a kind of market cap weighted position in each company where you'd end up having 10% or the top 10 being 1/3 of your portfolio, you would own an equal amount of every stock, so only 0.2% of every stock instead of 6-7% of Apple and 6-7% of Microsoft. The gray portions of this chart are eras in which that equal weight performance actually did better market cap weighted performance. And what you'll see is the green bars, this chart ends in 2023 with the green section being a better performer. That means that if you own just the top 10, you did better than the rest of the market. And so what we'd like to just point out here is that this kind of ebbs and flows. It's not always one way or the other. What's best is just to take a diversified approach and, don't worry about the year-to-year swing between the top 10 and the other 490. Over the long term, if you're invested, you'll compound with the whole market. So I think, the key takeaways are, we have to stay diversified. We have to stay invested. When we look at valuations and year-to-date returns, it wouldn't surprise us if we have a little bit of volatility, but by and large, there's still plenty of good opportunities to compound your money over the long term. Annette, those are my closing thoughts. I'd ask Will if he has anything to add. If not, we could turn it over to Q&A.
Sure. Anything, Will, from you?
Yeah, so I've got 2 points now. I
Sure.
actually on a chart that's actually pretty complicated underneath the hood with how JP Morgan went about developing this chart. So they're essentially trying to compare a whole bunch of asset classes to whether they're under or overvalued. And as interest rates have moved off of the lows from 2020, 2021 to higher, bonds went down. So it's made treasuries and core bonds very attractive. So you'll see from left to right on this chart, you go from low to high with JP Morgan's Z-score methodology. And given it's a Friday afternoon, we'll save the rigor of how that calculation performs. But the only other one I comment was the first slide of the section with the chart. It's a little bit of chart crime, in my opinion. It's not logarithmic, so it looks like a super steep hill when, in reality, day to day, from a percentage return basis, it's more steady from bottom left to top right. So don't let that chart scare you.
Thanks, Will, though. Yeah, the visual aids are like super helpful, but then you need the commentary from you both to digest that and, walk the audience through that. So thank you for that thorough explanation, both of you.
They're always a little bit more complicated than you like.
Yeah. So I try to use my little pointer effectively, but, I was having trouble with my mouse here today. Apologies if we bebopped around on the slides there a bit. I got a hang of it eventually. Thank you, you two. One thing maybe I'll just conclude with to share with you clients that Prime Capital, Scott, Will, and actually another colleague, Eric Krause, present quarterly this very content. It's a series called Making Sense of the Markets. And typically, this is done off the heels of every quarter, usually a couple of weeks thereafterwards. Up ahead, we already have our summertime date set for that. So July 10th, 1 to 2 p.m. Central Time. There's a QR code that you could scan if you wanted to get on the ball right away and register for that. But nonetheless, it is something that we're able to tap into because of our broader network and team members from Prime, that we can send these invitations for these webinars directly to you on a going forward basis. So come July and then later again in the fall, which should be sometime mid-October, we'll extend to you all those invitations and you can just register directly. This is something that we'll continue to have access to, and I hope you're getting value out of that. So as we conclude here, thank you, Will and Scott. I can take a look and see what questions came through here. We did get a couple of them. Oh, this is a good one. They're always good questions. I don't know why I preface it with, this is a good one. All questions are great. Scott and Will, how concerned are you about a reacceleration of inflation?
Sure, I'll go first. I would say not overly concerned. I think with interest rates in the high fives, Fed probably taking cuts off the table, reacceleration is less of a concern. We had said before, and I think it's right, it was easy to get inflation from 8% down to 4%. What's going to be harder is getting inflation from 3.5 down to 2. So I think it's less a risk of inflation shoots back up to 5, 6, 7%. We're not really seeing any catalyst for that. The concern is that we're probably just going to need to keep rates higher for longer. so that the Fed can accomplish its goal of getting back down to 2%.
Yeah, and I would agree. It's the stickier inflation that would be more of a concern. A reacceleration of inflation is probably going to be at the whim of some global geopolitical issue, if I had to guess, which would be a secondary effect, not a primary effect on equity markets.
Other question, we had a client ask about follow up with the slides. Certainly, we can circle back with you directly to get you that content. And then this is also being recorded, so we'll distribute that to everyone as well. Other than that, perhaps you both did an excellent job of walking everyone through that. We don't have any other questions this quarter, so that's great. Thank you both.
Everyone's watching the golf. Which...
Yeah.
Here, I was focused on taxes, but you're right, Will. It's probably, we've got one screen on the presentation, one on the Masters. So
Yeah.
whatever you're getting up to this weekend, folks, have a great weekend. And Will, Scott, thank you again for this great content. Look forward to doing this again at the next quarter, July 10th.
Thank you.
All right.
Thank you.
Thanks. Bye, everyone.